Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and today's episode is called Don't Leave a Tip for the Government. Post-tax season planning starts now. The days right after April 15th are the most valuable of the year. Your numbers are fresh, your pain is recent, and opportunities are everywhere. Most people exhale, file, and forget. That's exactly how unnecessary dollars drift to Washington. We'll separate true tax from accidental tip, unpack your return like a diagnostic report, and build a practical action plan for rest of the year. No guilt, smart moves that keep money working for you. Let's start with the tip versus the tax. Tax is what the law requires. A tip is everything you pay because of late, missing, or poorly timed decisions. Tips show up as avoidable penalties. Taxable income you could have shifted or sheltered, deductions you didn't document, or credits you never claimed. The code rewards people who arrange affairs thoughtfully and consistently. It doesn't reward procrastination. When you treat planning like an afterthought, you volunteer extra cash. Think of me as your anti-tipping coach. We'll identify leaks, plug them systematically, and align your business and household cash flow with the rules. Right after filing, pull your return and highlight a few readings. Note your marginal rate, the tax on your next dollar, and your effective rate, total tax divided by taxable income. Did net investment income tax apply on interest, dividends, rents, or gains? Check alternative minimum tax if you exercised options or deducted lots of state taxes. Self-employed, add up self-employment tax and see how much was deductible. Business owners, review your Section 199A Qualified Business Income Deduction, percentage, limitations, and what reduced it. Those lines tell a story about where planning pressure exists this year and which levers actually move dollars today. Next, tackle withholding and estimates. If you got a refund, you provided an interest-free loan. If you owed, you may have paid penalties plus high IRS interest. Employees, update Form W-4 now after pay raises or life changes. Business owners and investors, set quarterly estimates that match seasonal income. Know the safe harbors, generally 100% of last year's total tax, or 110% if your adjusted gross income exceeded a threshold. Hitting a safe harbor avoids penalties, even if your income spikes. Automate payments, calendar due dates, and review mid-year so surprises become choices, not emergencies for you. Entity choice can quietly create a big tip. Many profitable single-member LLCs should consider electing S-corporation status to reduce self-employment tax. The trade-off, you must run payroll and pay yourself reasonable compensation. That requires planning, documentation, and a payroll system. Miss the window? Late S election relief is often available when intent and facts support it. Timing matters because salary paid late in the year may crowd out the qualified business income deduction. Review partner or shareholder basis, distributions, and state pass-through elections too. The goal is balancing payroll, distributions, retirement contributions, and QBI to minimize total tax legally. Retirement plans are legal time machines. A SEP IRA is simple and great for late adopters, but contributions are employer-only and can be costly with staff. A solo 401k allows employee deferrals plus profit sharing and Roth options. Simple IRAs fit lean payrolls and modest margins. High earners seeking large deductions may explore cash balance plans layered with a 401k. Deadlines differ. Establishing and funding windows aren't identical. Document compensation early so formulas work. Limits adjust with inflation, and future year numbers can change, so plan proportions, not guesses. The earlier you choose, the more pay periods you have to capture savings. Health tax shelters deserve a checkup. If you're eligible for a health savings account through a high-deductible plan, you get a triple benefit: deductible contributions, tax-deferred growth, and tax-free withdrawals for qualified medical expenses. HSAs can double as stealth retirement accounts if you cash flow current costs and save receipts. Flexible spending accounts are use it or lose it, so plan elections with real estimates. Coordinate premium timing and large procedures with the medical expense deduction threshold. Self-employed? Compare the self-employed health insurance deduction with itemizing. And remember, dependent care FSAs can subsidize childcare, improving cash flow while you reinvest savings into year-round planning discipline. Itemizing versus the standard deduction is a game of timing. If your deductions hover near the threshold, bunch expenses, stack property taxes, elective medical procedures, and charitable giving into 1 year, then coast the next. Donor-advised funds let you deduct appreciated stock now while granting over time. You avoid capital gains and potentially deduct the fair market value. If you're 70 and a half or older, qualified charitable distributions from IRAs can satisfy required minimum distributions without appearing in adjusted gross income. That protects credits and deductions tied to AGI. The theme, time big moves, simplify and align giving with tax leverage beautifully. Real estate and business assets offer powerful write-offs when timed well. Section 179 lets you expense qualifying equipment up to high limits, but it's limited by taxable income. Bonus depreciation accelerates cost recovery regardless of income, though percentages phase and rules change. For rentals, a cost segregation study can front-load depreciation on shorter-lived components. Home office deductions are legitimate when your space is used regularly and exclusively. Document square footage and expenses. The Augusta rule allows renting your home to your business up to 14 days per year, receiving tax-free rent with a corporate deduction when meetings are bona fide. Vehicles create confusion and opportunity. Decide early whether you'll use the standard mileage rate or actual expenses, because switching methods later can be costly. Maintain a contemporaneous mileage log noting date, purpose, and miles. For actuals, track fuel, insurance, maintenance, lease, or depreciation, and allocate by business percentage. Heavy vehicles over 6,000 pounds may qualify for larger first-year deductions, but business use still rules the day. No log, no deduction. Equipment purchases should follow a forecast, not a sale flyer. Buy because the numbers work, not because a salesperson mentioned Section 179. Match write-offs to expected profitable quarters and cash flow. Now the 20% qualified business income deduction. Below threshold incomes, most trades qualify easily. Above thresholds, you may need sufficient W-2 wages or unadjusted basis in property to support the deduction. Specified service trades face phase-outs based on taxable income, so entity design and spouse income matter. Reasonable compensation in S corporations reduces QBI but often saves self-employment tax. We model both sides. Leasing assets to your operating company can add UBI if commercially reasonable. Coordinate retirement contributions, health premiums, and charitable timing with taxable income bands. The goal, engineer your AGI to preserve the biggest QBI possible legally. 2. Overlooked home runs, accountable plans, and family payroll. If you operate an S or C corporation, adopt an accountable plan now to reimburse business expenses you pay personally, home office, mileage, supplies, pre-tax. Receipts and timely reports are required, but the tax savings beat after-tax draws. Hiring your kids for bona fide work can shift income into lower brackets. Under age 18, wages from a parent's sole proprietorship generally avoid FICA. Corporations require payroll taxes. Pay reasonable rates, document tasks and time, and consider directing earnings to a Roth IRA. You'll build lifetime compounding while reducing current taxable income and stress. Capital gains deserve year-round attention, not December panic. Monitor positions monthly and harvest losses to offset gains and up to $3,000 of ordinary income. Watching wash sale rules. Use asset location. Place tax-inefficient funds and bonds in retirement accounts and broad index equities in taxable accounts. If your taxable income is modest, the long-term capital gains rate can be 0 within a defined bracket. Plan Roth conversions, business deductions, and charitable gifts to open that window. Consider installment sales to spread large gains or qualified opportunity investments when appropriate. Map every sale to your bracket before you click trade this year. Don't skip credits. The R&D credit can reward process improvements and software development, not just lab coats. The Work Opportunity Tax Credit targets qualified hires. New retirement plans may generate startup credits alongside deductions. Energy-efficient property upgrades can earn incentives. State moves matter. The SALT cap still bites, but many states offer pass-through entity taxes. Evaluate your state, including Missouri's PTET and MO 529 deductions. Crypto and side hustles require pristine basis tracking. 1099K thresholds are evolving, so reconcile early to avoid phantom income. Good books win audits. Monthly closes, separate accounts, receipt and mileage capture. Extensions aren't naps. Use them. Let's close with a 2026 action calendar. Q2. Debrief your return, fix W4s, set estimates, choose entities and retirement plans, adopt an accountable plan, and start your mileage and receipt systems. Q3. Mid-year projection, adjust payroll and contributions, harvest losses, bunch deductions, and schedule equipment deliveries. Q4. Finalize compensation, QBI positioning, charitable strategies, PTT elections, and state credits. Extension filers. Use the runway, don't coast. Work with a professional planner to implement, monitor, and update as life changes. I'm David Robson. Thanks for listening to Tax Smarts Unlocked. We covered withholding, entities, retirement, QBI, real estate, credits, crypto, and bookkeeping.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.